BWS continues to brief you on financial facts, market signals, and wealth ideas. Welcome to our weekly deep dive for the week ending March 15th, 2026.
Hey everyone, welcome. This week, the market wasn't just walking a tightrope, the rope was on fire. The S&P 500 wobbled around 6,632 before finally buckling under geopolitical pressure.
Exactly. Nasdaq dropped 1.3%. Tech stocks are basically glass cannons when commodities spike. Monday morning, before the coffee even got cold, news from Iran sent oil prices on a rocket ship.
Don't forget the Dow down 2%. This isn't just volatility. It's panic. We're grinding against 2026 lows, and the bears are smelling blood in the water.
All right, let's not just wallow in the red. Today we're digging deep. Why high leverage became this week's killer, and the latest Musk family rumors. Let's dive in.
Let's look at our first warning sign, margin debt. As of January, it hit a record 4.07% of U.S. nominal GDP.
What does 4.07% mean? Before the 2000 and 2008 crashes, this was only 2.5% to 3%. The gambling with borrowed money has reached insane levels.
Precisely. This means a mere 5% drop next week could trigger a massive wave of margin calls. It won't be your choice. Your broker will just liquidate you.
So while the Financial Conditions Index, NFCI, looks loose on the surface, the flow is thinning out. Liquidity risk is brewing beneath the waves.
In the credit markets, high-yield spreads are at 3.17%. No crisis yet, but they're starting to twitch, reflecting those geopolitical inflation fears.
Powell is under massive pressure. The Fed is holding at 3.5%, but Trump is calling for 200 to 300 basis point cuts. This public feud is confusing the hell out of the market.
Plus, with the 10-year Treasury hitting 4.28%, the bond sell-off is shouting one thing. Nobody trusts that inflation is under control. That lack of trust is deadly.
To recap the week, it's the start of high leverage meets sticky inflation. Next up, we've got some spicy secrets from the whales shorting the market.
Time for some gossip. The legend investor Michael Burry keep warning that the market is structurally becoming more fragile.
He was depicted in The Big Short. Burry significantly boosted his Palantir puts. He's literally firing shots at the AI hype train. He believes the next downturn is more violent than the dot-com bubble burst.
The kicker? Peter Thiel also dumped Nvidia. When the market wizards start exiting while retail is screaming diamond hands, it sends a chill down my spine.
So is Burry crying wolf again, or is he a prophet? Let us know in the comments. Who do you think has the upper hand?
Next Wednesday is D-Day, the FOMC meeting. Rates likely won't change, but we are laser-focused on the dot plot.
Exactly. If officials slash the 2026 rate cut forecast from 3 to 0, the second half of next week will be a total bloodbath. Get ready for a hawkish shock.
And don't forget the succession drama. Trump's pick, Kevin Warsh, is watching from the wings. Every word from Powell now carries massive political weight.
We're hunting for clues of stagflation in that presser. If the Fed admits growth is slowing while inflation stays high, growth stocks are toast.
Everyone is staring at CPI, but we're watching PPI on Tuesday. With oil jumping from $80 to $100, producers can't hide those costs forever.
Plastics, shipping, electricity, it's all going up. If PPI beats expectations, it means corporate margins are getting eaten alive. That's a stock killer.
Wall Street consensus says inflation will fade, but PPI might give that blind optimism a loud slap in the face.
So on Tuesday morning, check your exposure to manufacturing and consumer goods before the numbers drop.
It's a quiet earnings week, but there's one company I'm watching, Dollar Tree. It's the health report for the bottom-tier American consumer.
If sales at the dollar store are sliding, or if they say they can't pass on costs, it means the consumer's wallet is officially bone dry.
Consumption is 70% of U.S. GDP. Even a tiny miss from Dollar Tree reflects a recession risk that is massive.
Don't just watch the trillion-dollar tech giants. These boots-on-the-ground companies show the economy's true colors.
Iran is still the biggest black swan. If a spark flies in the Persian Gulf, $120 oil isn't a joke, it's a reality.
Watch Trump's Truth Social. He's positioning himself as the peacemaker. One post saying conflict near end, and the market flies.
But if he pivots to tariff threats or military posturing, risk assets will run for the hills. The era of market by tweet is back.
I suggest turning on his social media notifications for next week. It's more useful than any analyst's report.
Last but not least, market voice. The big banks are retreating. Goldman and Barclays look bullish on the outside, but they're preaching defense.
Only some Wall Street bettors is still screaming by the dip. We need to see how long retail momentum can hold. If retail capitulates, that's the real bottom.
This ultimate game of chicken between institutions and retail usually ends with retail getting clipped. History loves to repeat itself.
Stay sharp. Don't get swept up in forum hype. Next week's volatility could be the highest we've seen all year.
Wrap-up time. The biggest risk this week isn't geopolitics, it's leverage contagion. That 4.07% margin debt is a ticking time bomb.
The illusion to ignore is the SpaceX IPO hype. In a liquidity crunch, it's just a new pump to get more cash out of the system.
Don't be fooled by short-term bounces. As long as oil stays high, every rally is a gift to sell into.
Cash is king, or move to defensive stocks with massive cash flow. In this environment, survival is the only goal.
Your playbook. Watch PPI on Tuesday for your positioning and FOMC on Wednesday for your direction.
If you hold Tesla, watch Kimball's feed like a hawk. If you're a bull, your only shield is the NVIDIA Developer Conference.
Keep an eye on the energy sector. If the broad market melts down, that's your only bunker.
That's our deep dive for the week. Good luck keeping your capital safe. If you like this four-way breakdown, hit like and subscribe. See you next week.
Thanks for watching. Please subscribe to our channel for your weekly financial briefing. See you next time.